Welcome to the Anton Stentner podcast. Today, we're talking about the Fed's big lie, why interest rates are crashing. And we're going to talk about what it means for you guys that are listening. Anton, tell me what is going on, because I've been kind of MIA for about 3 weeks and I've been seeing a lot of news.
Yeah.
But what you don't see as much is Jerome Powell, rates, but it looks like it's back on the table, or at least the conversation is back.
I think everything has changed in the last 2 weeks. And the Federal Reserve, Jerome Powell's out. We're independent. We're not political. But when the president is basically calling you a numbskull and saying, he's not a very smart man, and then Wall Street and Main Street are kind of begging for cuts, you have to ask yourself, how independent is the Fed right now? And what we're going to talk about today is we've got shrinking GDP. We've got a weakening job market with the ADP report that just came out this morning. We've got inflation trending in a downward direction. We have the Fed's rhetoric is shifting on Papa Powell and people like Bowman, traditionally a hawk. The bond market's kind of screaming at us, a recession is coming. And so this isn't just about rates. This is about credibility. This is about timing. This is about monetary policy and politics, all smashing together. And what our subscribers know is that we always try to be ahead of this data. We're trying to give you a forward-looking indicator so that you can take part and benefit in what we're seeing. And then we're going to finish up this episode with what does this mean for you, your money, and the good old real estate industry?
Boom. Okay, so are we going to start first with GDP is shrinking?
Yes.
Okay.
Yeah. When GDP starts shrinking, and 2 quarters of negative GDP is the formal definition of a recession. And in Q1, GDP contracted. We had negative GDP, the gross domestic product. So that means the economy shrank a little bit. Now, that's not necessarily a soft landing. That's the economy shrinking. So this is kind of this is our base case. This is what I'm saying. Everything is slowing down, and it marks a serious slowdown from the previous quarter, because the previous quarter in Q4 of 2024 was 2.5%. GDP growth below 2% has preceded 10 of the last 12 recessions. So clear warning sign of recession. And these are the factors that I believe are going to push this rate cut out.
And if you do 2 of those, right, 2 quarters of that, then that would be technically a recession.
Yes, but the government has to call it. And during the Biden administration, we had the 2 quarters and they did not call it. But everyone around us was like, buddy, we're in a recession. I feel it. My money is not going that far. So I think we can pull this out. It's not going to be a soft landing. It's going to be a turbulent, bumpy landing today if we pull this out. So what some of the economists are saying is they're saying, well, our economy had to front load because of the tariffs. So we had to import dramatically more than we exported. So that pulled down the GDP number. But I want you to ask yourself this on a personal level. Do you feel like the economy is improving for you right now? Are things getting easier, or are they getting harder today?
My perception is it's not getting easier. It's getting harder, and not just for me, but other people around me and more broadly.
Yeah, so the average consumer feels like it's getting harder. They feel like the economy is already slowing down, but the way the government measures the data, it measures it in kind of a backward-looking manner, so it's slow. And the Federal Reserve is still saying inflation's the problem, but who cares? Inflation is basically beat, and so we've got to get ready for problems that are literally on the horizon right now, and the Fed to start consistently fighting with itself, and signs that things are cracking.
What is cracking specifically?
Right now, the labor market. So the JOLTS report came out this week. JOLTS report was good. It was high. But then the ADP came out. And ADP is the private payrolls. And the private payrolls for June was supposed to be forecast 100,000 jobs. Actual negative 33,000. So this isn't a miss. This is like you drove off the cliff. That's missing expectations by 133,000 jobs in the private sector. The government's going to ignore this because it's private data. But ADP is the largest payroll provider in the United States. This is like data. This is the gold. This is the thing we should be watching. And what's also interesting is you're seeing this softening because our economy, we are a service-based economy. And you're seeing this softening in the services sector, in high-skilled sectors, in white collar, and in general business confidence. So that combined with the slowing BLS payroll data, basically cracks are showing up. And another interesting thing I think is going to happen, this is just something to pay attention to. Companies right now are kind of getting wise. So instead of a tech company saying they're going to lay off 10,000 people and doing it all at once, they're turning it into these trickles where they're just laying off 500 at a time, 1,000 at a time. So it doesn't hit the headlines, but they're still cutting their workforce. And I think that's going to continue because it doesn't make them look like the big, bad wolf while they continue this trickling of laying people off.
I feel bad for employees on Fridays.
Yeah, exactly.
Like, oh my gosh, Friday's coming along.
Well, even coming into a holiday weekend. So, okay. If I was an HR person and the Friday is the 4th of July, and I mean, you're going to let them go on Thursday because they get a big holiday weekend sitting right in front of them.
So with that being said, one of the things that you don't hear a lot about because it's being overshadowed by tariffs is inflation. Where's inflation at right now?
Yeah, so inflation is cooling, but they keep saying tariffs are the wild card. I believe tariffs are a one-time shock to prices. In other words, once the tariff is established, it pops up once, and it doesn't, keep moving from there. But what Jerome Powell keeps saying is we're waiting on the tariffs. We're waiting on the data. So it's starting to feel very political. PCE core, which is the Fed's favorite metric, has cooled to 2.7. PCE itself is 2.3%, getting very close to the Fed's target of 2%, which means inflation is no longer the boogeyman. We're not waiting for inflation. And if you look at the graph, dude, it's just slowly trending down. Yes, it pops up and down, but overall it's trending down. Which
is a surprise to me because I have been waiting for it to pop up because tariffs were so extreme. We're talking a legit trade war. I shop for groceries like multiple times a week, and I've been just trying to see it in the prices. I don't see it in the prices, number one. And then two, the question is, how long does it take for the tariffs and the trade war consequences to hit? But we're talking right now, we're halfway through the year.
Yep.
It started in first quarter, and we're not seeing it. Do you think it could come like in the third quarter or fourth quarter?
It actually technically started already showing up because that's a lagging effect, and it shows up like 60 days later. So Liberation Day was in, April, if I remember correctly. So then you've got May, June. So it's already started showing up. Where you're seeing it show up, though, is companies are taking it in the margin. So the tariff is currently not being passed on to consumer, and companies are eating it inside of their margins.
Why would they be doing that?
Because, well, I got a couple reasons. Is one, I believe they know the economy is slowing down and they're feeling it. So they don't want to lose the traction and the velocity of their cash, and they don't want to lose that consumer.
Yeah, they don't want to lose the customer that they have.
Because, I mean, literally one of our next points is consumers are spending less. And so as consumers are spending less, you can't piss them off and say, by the way, this pen is going to cost more. They're just going to go and find a different alternative or go purchase it from someone else. What this also means, though, Benji, and our audience, our listeners, understand that with the Fed's fund rate at sitting where it is today at 4.25 to 4.5, the Fed is sitting in very restrictive territory. As inflation cools down, the Fed funds rate becomes more restrictive. This is why everyone is screaming, cut, cut, cut. And with the Fed's preferred inflation, PCE, showing no clear signs of not continuing to drop, it's crazy that they haven't cut yet. And you're also starting to see actual signs of deflation on the horizon. Deflation is when prices start to go backwards. Disinflation is the speed at which prices slow down. So you're seeing disinflation signals today, which become deflation in the future. Deflation is a massive problem that usually leads to major recessions, the great financial crisis, the Great Recession. Why we're seeing that is we're seeing weakening demand and consumer behavior, aka decreased consumer spending, falling incomes. And then if you go look at like student loan debt, credit card debt, you can see them still just going vertical. So the consumer's running out of money. You're seeing sector-specific price declines in durable goods deflation. And then, of course, where we're at in real estate, the housing market softening. And then you're seeing some of that be trend down in places like Austin, in places like Florida. The producer price index, that's what producers pay for the goods, that's falling. So producers are paying less for the input material for them to produce things.
Isn't that also partly because China, for example,
Yes.
has to lower their prices because of the trade war?
Yes.
It's kind of crazy because some of Trump's plans are actually working.
It's literally, it's right there. Like it's just further down the list.
Wow.
So the next one, global factors, specifically China. No, you nailed it. You nailed it. Because so whether you agree or disagree with Trump's method and his plan, it's working because China is hurting. So China's on a deflationary streak. They're oversupplied. They're experiencing weak demand. So the prices are dropping. I was watching a YouTube video, and it was Meet Kevin, and he was talking about the Segway brand because his kids like those little electric scooters. And he was showing on YouTube, he was just like screen sharing, how the prices on those electric scooters had come down like 30%.
Wow.
So that's hundreds of dollars.
Because the inventory is being sat on. They
Bingo.
don't want to sit on it. They want to move it. And the logical thing to do is rather than eat that 100%, it's just lower the price and get it out the door.
Bingo. This is the warning signals. This is why rate cuts are coming. You can't have the globe slowing down and the prices of goods dropping in a consumer-based global economy, period. That will lead to rate cuts. That is our thesis here. So you got monetary policy next. Central banks are basically, they've been aiming to combat inflation, but what's happening is all of your central banks have started cutting, and you've seen they've started expanding their monetary policy to stimulate their economy. And there still is, though, a noticeable split between the sticky services inflation and goods deflation. Services inflation is the amount that we have to pay to get the work done. And so wages are still high, which is actually good. It's cool to see wages growing. Wages grew after COVID. We've grown more wages in the last few years than we have like in the previous decade. I like seeing this. I don't care if it's inflationary. I want to see our people making more money, which then leads us into what the bond market is actually doing. The bond market has really started screaming and showing us what's happening. So where we were a little over a year ago was the bond market yield curve is inverted. An inverted yield curve is where the 2-year treasury is higher than the 10-year. What that means to the listener is short-term debt should never be more expensive than long-term debt. That is often a massive recession indicator. But now the 10-year is greater than the 2-year.
So it's balanced out.
It's balanced out, and you've seen the spread between the two narrow, a positive indication of forward-looking lowering of rates. And both of them, the yields are falling in tandem. So all you have to do is go Google 10-year treasury and 2-year treasury, put it up to 6 months, and then look at both of them trending down. Yes, they pop up and down, but overall, they are both trending down and falling. And there's essentially a flat yield curve between the two at 0.48%. What this means is it means that bond traders are bracing for a recession. So bond traders right now, they're not just guessing, they're putting billions of dollars to work on the line, and that causes the Fed to move. Because both of these are trending in a downward direction, the 2-year and the 10 means you're headed towards cheaper debt. For our real estate people, understand that as the 30-year fixed debt gets below 6.5, That is your technical data line where the market starts to relight on fire. We were up at 7 and slightly over 7. Today, we were at 6.65 when I looked this morning. So we've already come down. We're headed towards that technical line at 6.5. And if you look at the 10-year Treasury, we've talked about this before, but I want you to understand that you can add 250 basis points or 2.5% to the 10-year, and that gives you today's debt rate. If the historical spread was there and the risk was out of the market, we would be at 6 today. If the mortgage lenders just simply took their risk premium out of the market. And so what I'm trying to tell everyone is the data is saying rate cuts are coming. The 2 and the 10 are both pointed down. If the risk was removed, we'd already be at 6. So we've got a case coming for us to get into the low 6s possibly by the end of the year and into the mid 5s next year. That is a quick, speedy, on fire real estate market. The Fed is really stuck here though. And you said you hadn't been hearing much from Powell. Powell was actually just on the news. And the Fed is stuck in this dilemma. Like, are we data? Are we politics? It's looking very political right now with Jerome Powell and Trump butting heads. Trump called Powell a moron and said that we need to save over $1 trillion in interest. So it's really starting to make every decision look political. What I don't like about this is damaging the American brand. This is damaging us and hurting us with investors into bonds. President Trump in the last week also went as far as saying that the Fed's funds rate right now should be 1% or 300 basis points lower, 3% lower. That means 30-year fixed debt would be 3.5% to 4%.
Now, that's just what he says, right? So, like, it has no influence from what we've seen in terms of Powell. He's even said it verbally,
yes,
even non-verbally, and also his behavior is like, hey, I don't care what this president's saying.
Yeah.
I'm kind of doing my own thing.
Yes.
So why is that significant to you, though, that Trump would say something like that, so audacious in terms of, like, what will actually happen?
Because in his book, The Art of the Deal, he talks about throwing a crazy proposal or a crazy number out there and then working back from there such that that one seems insane. But you know what? Maybe 2%, 2.5% isn't that bad. And so this is the art of the deal in action. He's throwing it out there to put the pressure to get the whole populace behind this. And they are doing everything. And so you've even got, what is he? Pulte. Pulte is the director of FHFA or something like that. He's on X every day, literally. The multiple parts of the administration are just lobbing stones at Powell, trying to get him to lower rates, which leads us into this idea that they've been talking about. And when I say they, a few pontificators, but I really believe in this, the shadow Fed president is going to emerge. And I think these are more than just rumors now, like this is going to turn into action. Besant said in the last 2 days that they will announce the next Fed chairman or chairwoman within the next 30 days. What's going to happen is whoever takes that job, Jerome Powell's going to come out and say, we're data dependent, we're not going to cut rates. But they know that Susie over here is going to be the one taking the job. And then Susie's going to walk right out on camera 30 minutes later and be like, don't worry, as soon as I'm in, we're cutting rates. And the stock market and the bond market are forward-looking indicators by anywhere between 90 days to 9 months. So let's call it 6 months. Well, if they know that we have a dovish Fed chairman coming who's going to lower rates the second we get in, the bond market will start artificially pulling rates down in anticipation of that because it's a forward-looking indicator. The person doesn't even have to be the chair to undermine Powell.
Because that was one of my questions. does like, for example, for recession, is it the expectation of recession that causes the recession, or is it like the actual things that are happening that creates a recession? Same thing with rates, right? Is it the expectation that rates are going to go down that helps it pull it down, versus is it like people actually making decisions that makes it go down? Does that make sense?
Yes.
And so this is a good example of this, like, they're not in power.
Yes.
They're just being like suggested, like, this is the person we're going to nominate. And then that person just talking with no power at all.
Yep.
But then the expectation that that person is going to do that thing is what actually guides the market. And then my next question is, if they're going to announce in the next 30 days, when does that person replace Powell?
May of 2026, they get replaced. But you were brilliant in what you just said. So I want our listeners and our subscribers to hear what Benji just said. It's the expectations and not the reality. The expectations are because we're emotional beings, humans are. And so we respond to the emotion. So if everyone believes you're in a recession, you all of a sudden magically are in a recession. If everyone believes rate cuts are coming, rate cuts just start happening because the bond traders start trading like that. Because they're trying to make money. And in the future, if they know it's cheaper, they'll start moving the money now.
Yeah, so it's not just it's not just bond traders, but it's bond traders and investors like us.
Yes.
It's literally bankers and people that make the decisions on those rates.
Yes.
So like you said,
real estate investors, the stock market, hedge funds, insurance companies.
one thing that's actually inflating interest rates is that risk that they're baking in. So if all that goes away, even before interest rates go down, interest rates go down at the Fed, they can come down in terms of what the consumer is paying.
Yes.
And then once they do make that decision, it'll be way more down. But what people will do, and like, let's just think about this as an investor. When's the best time to buy? When everyone is trying to buy the good deal, or when no one's trying to buy the good deal? And so that's where you could see, I guess, I don't know if I'm skipping too far ahead, but potentially what you could see is a mad rush and demand for real estate again.
You are skipping ahead, and we've got the rush for real estate coming. I believe your stock market's going to push beyond its all-time high. I believe our economy is going to continue the great melt-up. As I did this whole episode, as I was doing the research, I was like, oh my goodness, this is the great asset melt-up that we talked about, what was that, a year and a half ago? I was like, we got to do a follow-up to that one, because this is what we're seeing in real time. And for the people who want to get deals, you want to be buying now before things start to inflate. What's happening too, because of this, Benji, is now you've got people inside the Federal Reserve who are also changing their tone. So Vice Chairman Michelle Bowman, she is known as a hawk. A hawk is someone who is tight monetary policy, doesn't want to juice the economy. She openly said that rate cuts in July are on the table. This woman is at 10 on a scale of 1 to 10, with 10 being a hawk. For her to change her tone about that, she's either seeing something in the data. The public likes to beat up the people who are on the Federal Reserve. They're freaking brilliant. They're all massively well-read. They're all financially secure. They all have all these degrees, and they've accomplished something major in money, banking, and finance. So when one of these people dissents, breaks ranks and pivots, you have to think, it's like, is she seeing something in the data? Number one. Or number two, is she now raising her hand and saying, hey, by the way, hire me. I want Jerome's job.
That's what I'm thinking. She's like, maybe I could break my loyalty to Powell and be like, Trump.
Yeah. Totally. So she could be raising her hand and saying, interview me. But there's a lot of signal. So we're seeing signal show up in the data that's pointing towards these rate cuts. And where I want everyone to be thinking about this is we're going to take a look at history, and then we're going to talk about what this means for you today. So a look at history is when rate cuts happen, generally speaking, your borrowing costs go down. Now, this is borrowing costs for real estate, for lines of credit, for auto, for credit cards, business debt, all of the above. As rates come down, the economy speeds up. But even though that's favorable, there's always volatility around it. So we're going to go back to something we've said a lot of. We need to be cautiously optimistic. I need a little more cash than you normally would. But these rate cut decisions and the climate is really going to define the outcomes over the next 6 to 18 months. So we look back at history. We had the dot-com bubble in the early 2000s, and that led to rate cuts. The Fed aggressively cut rates to cushion the fallout of the tech sector. Then you had the great financial crisis in 2008. Lehman Brothers crash. By the way, they said everything is fine. Everything is fine. It's okay. The data is good. And then Lehman Brothers happened. So I want to point that out. Like, the Federal Reserve has been wrong multiple times. They said inflation is transitory, and then we got, smacked super hard with the worst inflation we've seen since the 70s. During the great financial crisis, they slashed rates to near zero to prevent the meltdown. So then during COVID, 2020, same thing. We turned on the money printer, and we dropped rates dramatically. The problem is we kept rates too low for too long. There was too much money in the supply, too much supply of the money, which caused that massive inflation. So history is not going to repeat itself, but history, it rhymes. And this is going to stimulate investment and consumption and then boost prices from stocks to real estate and other investments. Okay, so now let's break this down for our people. Sellers, what does this mean? It was kind of a slow start to the year in real estate. And for the sellers, as rates come down, the market will continue to heat up. There will be more buyers. If you are a move-up seller, you need to be genuinely looking at, am I moving up, and how is that price bracket working right now? What's the demand in it? And if I'm moving down, you probably need to sell sooner versus later, because the lower the price is. When rates come down, when things are near the median and below price for the area, so basically the average, a normal house, that house inflates the most. It's not the home that's way up here. It's the one that's in the middle that everyone can afford. Buyers expect more competition. So the buyer that needs the closing costs, that needs the contingencies, you need to get in now. You need to hurry. You're going to get cut off as rates come down, because they're going to come down a full point, maybe 1.5 points from where they're at today. Expect the market to light on fire. The market's good in the Seattle Metro. This would cause days on market to drop, price reductions to drop, and a bidding war on everything. I did a class for a brokerage yesterday, and I proposed this thesis to a bunch of real estate brokers in the room, and everyone said 100% agreement. So rates come down, expect massive bidding wars here in the Seattle. Investors, I want you to think about two specific things. As rates come down, the wannabe investor comes back. So right now we only have the real investors. The real ballers, the real players are out there, and you should be negotiating fiercely. I got sent a deal by a wholesaler without even looking at it. I just replied back, price is too high. I'm just telling everyone no. Because all I got to do is say no once or twice, and they keep giving it to me at a better price. But investors expect more competition, expect the wannabe investor to come back, but also expect the benefit of declining cap rates. And I want to get real specific on a quick example. For those of you that are near your cell phone, I want you to think about a net operating income, an NOI of $100,000 on a multifamily property. And the net operating income is just the income minus the expenses. The cap rate on multifamilies, as rates just shot up, has gone dramatically up, like 2%, probably on 1.5% to 2% on average. In some cases as high as 3 and 4%, depending on where you're at in the country. But let's just call it 2% to make the math simple. So if you were to go buy a deal today that you could make work at a 6 cap, so you have $100,000, so you take 100,000 divided by 0.06. That gives you 1.6666 repeating. So let's call it 1.67 million. So I got 1.67 million at a 6 cap. If rates drop 150, 200 basis points, and that cap rate drops 2 percentage points, so it simply moves back to where it was from a 6 to a 4. This is very typical of our Seattle Metro right now. You take that same $100,000 in net operating income and assume your rents didn't go up at all. You divide it by 0.04. That building is now worth $2.5 million.
Like literally in the next year.
In the next year and a half to 2 years. Let's call it 2. You made $900,000 over 2 years by simply buying a piece of real estate and letting rates come down.
And that's because the commercial market has been stressed for so long now.
Bingo.
And no one wanted to get into it except real investors who kind of knew this. And now what's kind of funny is those real investors will probably make the most money in the next couple of years. And even the sideline investors, when they come in, they will also make money. But then guess what happens? Crazy amount of demand, lots of competition. Then it's like the game as usual. Right now is the window.
Right now is the window. So this is the typical Warren Buffett quote. Be greedy when others are fearful and fearful when others are greedy. And that's where we're at. Not everyone's ready to get in and play. For your agents, I was asked a while ago, when was the best time in my career, the easiest time to sell real estate? It was 2012, 13, 14, and 15. Because we were coming out of the recession, and the number of agents usually lags the actual economy. And so right now, because I own brokerages, I can see what's happening. I can see the amount of agents that are producing, and we follow the whole market. What's happening is this isn't even the 80-20. This is like the 95-5. The 5 are killing it, and the 95 are just barely surviving and getting out of the industry. What will happen as rates come down is new agents and people who got out of the industry, they don't instantly flood back in. So you have a window of opportunity for my agents. I want you to really dig into your business today because you'll get an unnatural lift as the number of available sides per agent goes up because there's less agents, but we're selling more homes. You'll have anywhere between 9 months to 2.5 years of a nice upride. And don't take it as hubris. As your business improves, that's the economy improving. We're selling the same amount of homes right now that we did back when we listened to Dr. Dre and Gangster's Paradise, aka the 90s, and we need to get back into the 2020s and into the 2010s. That's 1 million to 2 million more transactions. And then for our land developers and our builders, right now is the time to go fill the pipeline. You want to be filling the pipeline because it takes so long to get that stuff to market. So we pack the pipe because spring of 2026 is looking good and even further out from there. So you want to be packing the pipe right now for the next 1 to 3 years. And then also be thinking about that hole that's happening in multifamily. If you can find a good enough deal to pack into the pipe there, I think that's going to you're going to kill it on the multifamily side as debt gets cheaper. So in closing, we've got this compelling case for lower rates. I believe 1 point to 2 points is very doable within the next year and a half. You've got a weakening labor market. You've got slowing GDP. We have moderate inflation. We have our president calling poor Mr. Powell names. We've got dovish shifts in the Federal Reserve and massive political pressure. So as always, I want to encourage you guys to subscribe and then share this with someone else. And then you need to pay attention in these volatile times. We need to pay attention because rate cuts for July, just literally last week, was like a 16 to an 18% chance. This morning, the odds of a rate cut in July hit 28%. And the September rate cut is going up. So the market is starting to bake this in. I just want you to keep watching and keep listening because this is one of those pivotal moments where it's an opportunity to make money based on the changes in the future. And I just want you to be ready as the U.S. economy changes and rates go down.